And that actually dovetails with a great story that's on the Bloomberg terminal today. Hema Parmar, our hedge fund reporter, wrote it, and it's about a lot of the pensions and endowments borrowing the playbook from giant multi-manager hedge funds. We're talking about separately managed accounts. Now, this isn't anything new, but the fact that they're embracing this more seems interesting to me. Why?
Yes, it's very interesting.
Yeah.
So we're looking at some of the biggest pensions and endowments, taking inspiration from the multi-strat firms and how they structure their investments in hedge funds. And so what we're seeing is more of them are looking at these firms and saying, okay, when we invest in a hedge fund, we can use an SMA and we can manage our risk controls. We can pull these levers in a way that's specific to us. They can get full transparency, they can be more cost effective. And through these things, they can be more tailored and they can mimic some of the benefits that these pod shops are doing.
Is that a reflection that that the situation they had prior to this maybe wasn't giving them either the returns, the transparency, or the control that they wanted?
Yes, it wasn't giving them the transparency and not the control. And to be clear, they're not trying to mimic or sort of compete with the Millenniums and Citadels of the world. You know, these firms are giant, they are complex, they have hundreds of pods. But these allocators are looking at these big firms and saying, you know what, there are ways, things that we can learn and ways that we can be more beneficial and more specific in how we invest in these hedge funds to save and to get more transparency.
All right, well, one of the people that you quoted in this story is Anne-Marie Fink. She's the Chief Investment Officer for Private Markets and Funds Alpha over at the State of Wisconsin Investment Board. And pleased to say that she joins us right now. That investment fund, $156 billion. She's also responsible for overseeing more than $70 billion in assets. Anne-Marie, I'm actually really intrigued by this trend, and Hema really put this on my radar yesterday before the story came out here. How exactly has your fund, has Wisconsin utilized this?
So we've used it for our a part of our hedge fund allocation, and it's been a great addition to what we're doing in a number of different aspects. One is we are able to understand at a much more granular level, as Hema was saying, the transparency, and it just gets us much closer to the assets and what the managers are doing for us. A second thing that's been helpful is we are able to reduce the amount of capital that we need to put to work to match the expected returns that we're getting. So we can use about a third of the capital that we would have to use if we were in a commingled hedge fund to get the same return potential. And then
basically what you're saying then, this is more cost effective and more efficient than doing a commingled fund?
Yes. Now, we're always going to have some of our commingled managers because there are certain advantages to working with them as well. But we are finding that it is a more, as you mentioned, capital efficient space, and therefore we're generating higher return. We're generating very strong returns.
So SMAs first became popular, after the financial crisis and after the Madoff scandal. They've increased in popularity more recently. What is happening right now that's making this more attractive?
So I think there's three things that have changed. One is we are seeing more talent that's interested in doing SMAs. So hedge fund managers, often some who trained at some of the pod shops, who are now on their own and are willing to do SMAs. The second is the technology is much better. So as you mentioned in the article, we are working with a group called Dockside. They actually are affiliated with a multipad. So they've developed all of the technology. The multipad is Walleye. And they've developed all this technology. They've learned a number of lessons, and now they're letting us kind of piggyback on that. And then the third reason is just the talent that we have internally at the state of Wisconsin. We have teams that can build, that know how to pick managers. We've gotten much more sophisticated on that front. And we even have a gentleman who works for us who used to run risk at a hedge fund. So we've got the risk and the manager selection capabilities in-house now.
And from the fund side of things, the hedge fund side of things, you mentioned there's more flexibility on their side. What motivates them to do more SMAs? Because it can be a bit more onerous than a typical commingled vehicle.
Yes, I think it takes a certain kind of hedge fund that wants to do this. I think it's managers that are less interested in accumulating a lot of assets, but are more interested in having closer relationships with fewer LPs or limited partners like SWIB. And so we're a great solution to get somebody really up and running quickly. It also, because we understand and we can see into the funds and what the portfolios are doing on a day-to-day basis, we can take more risk in two aspects. One, in terms of the risk parameters that we give a manager, because we can see what they're doing, and then two, in the managers that we work with. So we can do a little bit more emerging managers than we might be able to do on a commingled, where it's more blind pool that we're investing in.
I am curious, though, Anne-Marie, about how many funds can really take advantage of pensions and endowments can take advantage of this. I was always under the impression that when it came to SMAs that you had to have a certain size and scale in order to make the numbers work here. Are mid-size and smaller funds, are they going to be able to follow this trend?
I think there is developing more ability. So the one thing that I think you can't get away from is having that expertise in-house. So you do need a certain amount of expertise in-house. And then also the managed account platform that we're working with, they help us with some of this, right? So they're negotiating derivative agreements with prime brokers and those kind of things. So that helps a little bit. But I do think you need some of the expertise in-house. But whereas once upon a time, it was probably only the mega size funds that could do this. I do think it's coming down into more of a mid-size, probably not yet a small group that can do this, but the mid-size, as the technology's gotten better, I think they can start to do this too.